Welcome to the How COVID Has Changed the Financial Behaviour of New Zealand Companies. I'm going to now welcome today's moderator into the conversation. Welcome, Katrina. Your microphone's open.
Thank you very much, Linda. Look, welcome to today's sponsored webinar, How COVID Has Changed Financial Behaviour of New Zealand Companies, sponsored by Taxpayers and hosted by CPA Australia. My name is Katrina Robinson and I'm a Relationship Manager with CPA Australia. We have people joining us from all over the country for today's webinar, so welcome. It is now my pleasure today to invite Nicola Taylor and Eric Jamont, and I'm going to now hand over to you, Nicola.
Trina and kia ora, Linda. Hey, it's lovely to be with you. Ina mana, ina reo, ina karangatanga, tēnā koutou, tēnā koutou, tēnā koutou katoa. Hey everyone, thank you so much for joining us today for our session titled How COVID-19 Has Changed the Financial Behaviour of New Zealand Companies. My name is Nicola Taylor. I'm the co-founder of tax technology company Taxpayers, and it's a real pleasure to be with you here today. Taxpayers, as I said, is a tax technology company. I'll just try and get my slides flicking through. Hey, and we're on a mission to change the way you think about income tax. We're IRD approved. We provide all companies with a better way to pay their tax, unlocking greater flexibility and a range of new business benefits. I'm sure we are already working with many of you. We think that paying income tax should be quick, easy, and reflect your company's unique needs perfectly. And from the Tax Traders team, like Katrina said, we also have our tax counsel, Eric Chamonte. He is still isolating at home after a dose of COVID, but he's here with us today online, and he is hovering eagerly, just waiting for any questions you might have. So do feel free to type those in, and he'll provide an answer as we go, and he'll be available at the end too to jump in. So we have 4 main objectives today. I'll just get those up there. Four main learning objectives. So by the end of the session, the plan is that you'll have a clear understanding of the immediate context that we're in, what that might mean for the way that your company utilises the tax pooling framework to pay your tax. We're going to look at recent COVID-19 tax law reforms and the options that this might open for your company. We're going to look, take a broader view and look at the changing tax behaviour of New Zealand companies that we have seen over the last 2 years. We've got lots of data to share with you. And again, we hope that'll provide you with more insight as you consider your own tax payment behaviour. And lastly, some potential ways to improve your own working practices. So let's jump in and let's get started. But and look, before I jump in, I want to say that there is a poll. Linda from Kahoot is going to pop that poll in, and you can take a look at those questions and answer those as we go through, and then we can look at the results a bit further on in the seminar today. So do have a look at those questions and let us know your answers. So let's jump in to the topic today, and to do this I want to take us back to 2014. Yeah, I want to take us back 8 years. It seems like a lifetime ago. What were you doing 8 years ago? What was your company doing 8 years ago? Were you even working there? Were you even working? But let me tell you a few things that were happening in 2014 in New Zealand and around the world. This is just some context setting. So firstly, this was happening. That's right. Frozen Mania was completely taking over every household in New Zealand. And parents, I am empathising with you for that. Here's a fun fact. Our youngest daughter was 2 years old when Frozen came out. Another fun fact, her name is Elsa. But it gets worse because in 2014, this was also happening. Gangnam Style reached 1 billion views on YouTube. We also had the Ice Bucket Challenge. On a much more serious and somber note, we had the disappearance of the Malaysian airline flights. And we had Germany. Germany won the FIFA World Cup in 2014 in the midst of growing speculation that Europe was entering a recession. But do you know what we didn't have 8 years ago? In fact, what we haven't seen in the 8 years since 2014? Rising interest rates. Through the tumult of Frozen and other worldwide tragedies and trends, in the last 8 years, interest rates were only going one way, and that was down. And in many ways, we've forgotten what rising interest rates look like, and this informs the discussion we're going to have today. So for those of you who remember, by November 2016, our interest rates in New Zealand were at 1.75. This was considered as low as New Zealand could go, until, of course, COVID hit. But from October 2021, our interest rates have been rising. Inflation is currently running at 6.9%. And this is the highest we've seen it in 3 decades. So we're seeing mortgage rates climbing, costs increasing everywhere, costs rising faster than salary and wages. And this is unfamiliar territory for New Zealand companies. We haven't been here for a while. So once again, we're seeing pressure on cash flow, which is increasing. And it's against this background that we can consider your tax payment behaviour for your company. So what we're seeing at Tax Traders is a slowdown in the growth rate of companies choosing to defer their payment of their income tax up front via our smart tools. And instead, we're seeing a transition to using those same tools to buy their tax after the fact via instalment plans. So that makes sense, rather than simply paying interest up front and then deferring the principal tax amount into the last moment where interest rates presumably will be higher. Companies are using instalment plans to pay their tax in a more cost-effective way, ensuring that more is being paid at a lower interest rate. Look, another helpful aspect of instalment plans, particularly given the current economic uncertainty, is the fixed payment profile. This can be very useful as you project forward. Increased certainty in an uncertain time is certainly valuable. And with our instalment plans, you can always flex these down the track if you need to, giving additional peace of mind. So we've had a quick look at interest rates. Now we're going to look at some recent tax law changes that may affect you and your company. And there's no pretty pictures for these, although they are pretty helpful. Like what I did there. Hey, firstly, the 2021 tax pooling extension. So if your company has been affected by COVID-19, you now have more time to settle your 2021 income tax liabilities if you have not already done so. Look, for those of you who we haven't worked with, who are unfamiliar with IRD's tax pooling framework, just let you know, by using our smart tools, you can have an extra 75 days to pay your outstanding income tax and reduce your interest and penalty costs at the same time. But the recent change, the recent legislative change, means that Inland Revenue has extended this deadline from 75 days up to 183 days to provide relief to businesses struggling with cash flow or resourcing difficulties if you've had lots of people isolating from the effects of COVID, if you meet the relevant criteria. I've popped the criteria up there. You can have a quick look, but you can see that to qualify for the extended time frame to settle your 2021 income tax, your company must have a terminal tax day of 17 January 2022 or later. Many of you on this call will have a terminal tax date of 7 April. So if that's you and you meet the impacted by COVID test, you now have until 30 September 2022 to settle your tax pooling arrangements. Of course, if you have a terminal tax date other than 7 April, you will have 183 days from 17 January, 7 Feb or 7 March as applicable. Secondly, you must have had a significant decline in revenue between July 2021, February 2022 due to COVID, resulting in an inability to fulfil your actual or intended tax pooling contract, or resulting in difficulty finalising your 2021 tax return prior to March 31. Finally, if you meet the 2 tests above, you must then ensure you have that tax pooling arrangement in place by 21 June this year. Again, even though you won't be paying for it until September. Orders placed after 21 June won't be able to take advantage of this concession, even if the other 2 criteria are met. Just a word on those criteria, they're self-assessed. So you need to satisfy yourself that your company meets that criteria. and hold sufficient evidence to support that self-assessment, as IRD does reserve the right to have a look at that evidence. Hey, the good news is if you're doing this via our smart tax tools, we have a checklist covering the criteria that we've just talked through, and our platform is updated with the new payment date. So everything you need to know, everything that we've talked through is there. Okay, so let's just have a look at some other recent changes. We can whip through these pretty quickly. There's been an increase in the debit use of money interest rate from 7 to 7.28% from the 10th of May. Note that the credit rate remains at 0. Now, the rate was set based on where interest rates were sitting at the end of March. So based on today's interest rates, it could soon be higher still. There's also been a removal of the pay in full and on time requirement to avoid UOMI for taxpayers who pay less than $60,000 for the 2023 year onwards. If you are a company that falls into that bracket, use of money interest will only be charged from the terminal tax date on any late paid income tax. So this means if you are late making a provisional tax payment, you'll only be liable for the late payment penalty amount in most cases. And because the late payment penalty caps out after 5 working days, once you are more than 5 working days late, if you haven't already paid, in many ways there's no practical incentive to pay before terminal date. It would be fair to say that not paying until terminal date wasn't Inland Revenue's intention, so it'll be interesting to observe what happens with respect to tax payments here and any potential response from Inland Revenue. Hey, lastly, we've been advised that Inland Revenue is making inquiries around tax avoidance for the 39% rate. If you are looking at your respective business, 2 areas to look out for would be personal services income, as was the case with our friendly surgeons in Penny and Hooper, and where there's been a change to the business structure that has occurred subsequent to the introduction of the 39% rate that has had a tax effect. All right, so give yourself a little brain break, have a little jiggle or a shake in your seat, because we have spoken about the interest rates, we've spoken about some recent legislative changes, and now we're going to get into what I think is very, very cool and very interesting, which is some of the broader trends and what we've seen with our data over the last 2 years, or actually coming up 3 years, that we can reflect on. And again, you know, my hope here is that it'll provide you with more insight and new data to help you advise your internal stakeholders around your company's cash flow and other tax-related issues. So if we're ready, we will dive into the data set. So our data set, just to let you know what we're drawing from, this is drawn from our $3 billion pool, more than 800 practices that we work with throughout New Zealand, and more than 12,000 taxpayers that we work with every day. And because we are the only tax pooling intermediary with fully integrated and IRD approved data connectivity between our platform and Inland Revenue, we can provide greater insight and a unique perspective on the tax paying behaviour of taxpayers who are active in that data connection. And that includes 90 practices and almost 37,000 taxpayers. So this allows us to build up a picture of what New Zealand companies are doing. We can empirically see what proportion of taxpayers are using a pool, how they're using tax pooling, and we can make recommendations based on what we are seeing New Zealand companies doing. So we're going to look at data about 3 tax-paying behaviours. Firstly, the deferral of provisional tax payments. Secondly, on-time payments into a tax pool. And thirdly, companies that are catching up on a missed tax payment. And we're going to take our pre-COVID year data and compare that to tax payment behaviour in 2020 during a COVID year. Also look at 2021 and some data looking at 2022. We're then going to look at two further behaviours: taxpayers dropping out of the tax pooling payment system, and taxpayers who don't pay on time and are simply willing to incur in revenue penalties and interest. So we'll start with data, looking at companies that decide to defer the payment of their income tax using our tools. Of course, if you're new to the tax pooling framework, within that framework, a company can choose to defer the payment of their income tax, and companies do this all the time to keep cash in the company. So either where there are liquidity pressures at play, whether that's capital projects, financial market costs, or other risks that require cash positions to be preserved. And I'm sure that many of you will have done this. So this chart looks at a rolling 30-day average of the dollar volume of tax payments being deferred. We've indexed this to 2019. So the flat line there at the bottom, which is obviously pre-COVID, represents a typical trading period. So any movement above the line represents a greater use of tax traders' tools to defer the payment of income tax, and below the line represents a reduction in the use of our tools, in this case to defer the payment of that tax. So looking at 2020 first, and I guess what this chart shows, perhaps unsurprisingly, is a dramatic increase in New Zealand companies deferring their income tax payments during April and May 2020. It's that big blue area there. So if you can cast your mind back, sometimes it feels like it was just yesterday and sometimes it feels like a lifetime ago. But obviously this period was our first lockdown. Companies were faced with uncertainty and wanted to keep as much cash in their business and keep as many options open to them. And I think, what we found really interesting here is that it was during this time that Inland Revenue was also providing lots of flexibility and offering remission of interest for taxpayers where they had been significantly adversely affected by COVID. But you can see here that New Zealand companies still chose to use the private sector to defer their income tax payments. So we see the increase in 2020, and then looking at 2021, we see another significant increase. And this is even though, again, if you can remember, there was no big period of lockdown. And in fact, confidence had been restored to many New Zealand companies. So the decision to defer tax payment was not limited to the period of lockdown in 2020, but was maintained throughout 2021, even though the market conditions that drove the initial behaviour no longer existed at that time. And finally, if we look at 2022, you can see that even though that is slowing as we move into May, reflected by that 2022 area moving closer to the 2021, there's still an increase in usage. And look, as we noted earlier, this reflects the change in the way that taxpayers are engaging. That we are seeing due to the rising interest rates, making financing and interest upfront payment less cost effective than other tax pooling alternatives compared with 12 months ago. So summing this up, like so many other things that happened under COVID, whether it was learning how to use Zoom really well or working from home, companies had the chance to consider new practices and new ways of working. And the payment of income tax has been one where New Zealand companies have adopted new practices and then held on to those practices after COVID. All right, let's look at our second tax payment behaviour. Another proactive use of tax payment tools is depositing income tax payments into a tax pool prior or on the date that they are due to Inland Revenue. And remember, again, if you're new to the tax pooling framework, if you are going to make your income tax payment on time, making it into a tax pool preserves maximum flexibility and options going forward, including the ability to have that money back in your account which many companies have made the most of that under the COVID period. So let's take a look at this now. So once again, that baseline represents a typical or pre-COVID year level of activity. And then if we look at our 2020 year data, we can clearly see the decrease of on-time income tax payments through the first 2020 lockdown, which is what we would have expected. This is taxpayers opting to hang on to the cash that they had otherwise marked for income tax payments. And then this rapidly increases basically as soon as we come out of lockdown, reflecting, companies wanted to pay their income tax as quickly as they could. And because this is a 30-day rolling average, these payments actually started at the beginning of May, almost the minute we got out of lockdown. But it takes a while for that to be seen in the representation. And again, you can see from the size that the rebound in May is twice the rate of the slowdown through April. But, I think 2021 is where the story gets particularly interesting. So not only do we see the inverse of 2020's decrease in on-time payments into a tax pool, but we actually see a substantial increase in these on-time payments being made into a tax pool from May onwards. Now, this is not the typical growth that we would expect for these tax payments, and it tracks with the similar increase we saw in deferrals for the same period on that previous graph. So during COVID in 2020, we saw an increase in payment deferrals, but this was met by a drop in on-time payments. So instead of paying income tax on time, companies were deferring their income tax payments. Cool. However, in 2021, in the period before our large lockdown, we've seen an increase in deferral and an increase in on-time payments. So this is different, and this suggests a change in behaviour. And for the 2022 year, we see things lifting again. There's an even greater use of on-time payments into a pool. And again, companies have learnt over the last couple of years, particularly about the benefit of on-time payments into a pool. And one of those which has really stood out through this period, I touched on it a minute ago, is the ability to get your tax payments refunded back to your business for a period of time, even if you're profitable and will therefore have tax to pay. So ordinarily, inland revenue won't allow you to refund your tax in that situation, but with tax traders, you can refund your tax with the ability to reinstate that tax position at a later point in time prior to filing your return. And many companies, many large companies did this during all the lockdown periods that we've had. So overall, this on-time payment data suggests that more companies are paying more tax, which of course is good news for the economy, and it shows that more companies are taking their experiences from COVID and the tools they used when faced with uncertainty and bringing them into their everyday practice using smart tools that make the most of the tax pooling framework every day. Okay, so we're going to look at one more transaction type for this period, and this is where companies have used our tools to catch up on a missed income tax payment from a prior period. So again, if you're new to the wonderful world of the tax pooling framework, with our smart tools, you can acquire another taxpayer's surplus tax via an intermediary like us, and you can have this applied to your income tax account. The benefit of doing this is that the cost you incur is significantly lower than the interest and penalty charges otherwise levied by inland revenue. So again, if we have a look at the data, we've got a similar 30-day rolling day average. The flat line at the bottom there represents a typical or pre-COVID period. So looking first at our 2020 data, as you'd expect, this is similar to the other charts we've seen, reflecting companies holding on to working capital and choosing not to make catch-up payments that they might have otherwise made. Look, this was one of the clearest indications of just how significant the financial uncertainty was at this time. It was actually the first time in our trading history that we had ever seen a relative drop in transactions through this period. But once again, it was interesting to see how quickly this reverted to normal, fluctuating around that zero line. as soon as lockdown was over, indicating that business confidence bounced back quickly and companies wanted to catch up on their missed tax payments with a high degree of priority. 2021, however, tells quite a different story. So whilst reverting back to a typical pre-COVID level of activity might have been expected before the 2021 lockdown, i.e. we may have seen that track closely to our baseline, here you can see in that dark blue area, this is not what we saw. Instead, we've seen really strong growth across almost the whole period. So just to be clear, what we've just seen in the on-time payment charts is that on-time payments into our tax pool increased in 2021 prior to that 100-day lockdown. And here we see that at the same time, catching up on missed tax payments has also increased. So this is unusual. This doesn't usually happen. Companies that are paying on time are not usually the same ones needing to acquire more tax. For 2021, this is consistent with companies that are not just profitable, but are much more profitable than they expected to be, and they need to catch up on their tax payments. Taking it a step further and looking at 2022, we can see that things have lifted again across the board. And unlike finance arrangements, the deferral, this is showing no sign of slowing with the rising interest rates. And that is likely due in part to the fact that the impact of rising interest rate flows much more slowly into the catching up of missed payments. Okay, so have another little brain break if you need. Have a little shake in your seat. You're doing great. I hope that you are tracking well here. And we're going to turn to the last two behaviours. And this is taxpayers dropping out of the tax pooling framework, and we're going to see what our data shows us. So for the year ended 2021, we took a sample of 1,018 New Zealand companies. These were companies that had used tax traders for the prior 2 years, but then did not use tax traders for the year ending March 2021. And just to add some context here, when we see a company with a track record of using our tools, and then they completely stop using our tools and dropping out of the tax pooling system, it's a pretty clear indication that that company is no longer profitable or has ceased trading. With our SME market, we have a 98.5% retention rate. So if they're dropping out, it's because they're not profitable anymore or they've ceased trading. And so within the sample size, we saw that the overwhelming majority of those that dropped out of the tax pooling system were companies who historically had an income tax bill of $100,000 or less. And that's what we're using as a proxy for what denotes an SME. On the flip side, we saw that larger taxpayers, so those that pay more than $100,000 of tax, have demonstrated strong growth. So 35% of those increased their income tax obligations by 50% or more. And then when we consider this for the year ending March 2022, we could see that our sample size, although it was smaller, we saw fewer companies dropping out, but the proportion of those that were paying less than $100,000 in tax, i.e. those that we classify as SMEs, was much higher, sitting at 95.7%. So what we can infer from this data, and again, I'm no economist, but what we can infer from this data is that the benefits of the economic support provided over the last 2 years has probably not been shared equally across the economy. Although at a macro level, our economy has been performing reasonably well, there might be some degree of consolidation with our larger taxpayers. And looking at the data on companies that have dropped out, it's certainly indicating what I guess we all know to be true. We've seen it all around us, that some of these gains have come at the expense of smaller and less resilient companies that were unable to weather the storms of 2020 and then 2021. So just one last data set that we can look at to consider changes to company tax payment behaviour. And this is taxpayers who are not paying on time, but are instead incurring use of money interest and or late payment penalties. So the data set here is 40,000 taxpayers, and those that incurred interest and or penalties was 7,400. And those that were using tax pooling was 2,600 taxpayers. So this shows that there are a lot of taxpayers for whom paying in revenue on the dates in revenue wants the money doesn't suit them. There may be a whole range of reasons as to why, but regardless of the reason, it happens, and the cost to those taxpayers of the Yomi and late payment penalties is high, given the alternative that they can access through the tax pooling framework. If you happen to be at one of those companies that doesn't always pay in revenue on the due dates, obviously give us a call, we can help. Okay, so we've looked at the broader picture of what our data might be telling about how companies have changed their tax payment behaviour. And then now we're going to touch on ways to improve your own work practices. And I think this is where we come to our poll. So as part of this webinar, we were asked to include a poll, which I think you saw at the beginning, on a couple of questions. And I'm just going to have a little look at the answers there. So firstly, we asked whether your company is reactive or proactive when it comes to paying tax payments. And let's have a little look here. Can't see that one. My eyes might not be good enough for that one. But the second question we asked was, does your tax team have to rely on manual calculations or using spreadsheets? And it seems that, let's have a wee look. Yes, 53% of you do, and no, 39% of you don't. And on that first question, are you reactive or proactive? We say, so 36% say they're proactive and 56% say that you are reactive. Moving on to the next question. So do you have to decipher in revenue statements? Do you have to have like multiple data sources with multiple windows open? And let's see, 53% are saying yes and 36% are saying no. Is human error something that also crops up occasionally due to inefficient workflows? This is a real honesty question, right? And what we've got is yes, human error does crop up, 44%, and looks like the same number are saying no. So I'm not sure about the maths there, but so those things are real, and those things are real for all the clients that we work with. And these are challenges actually that all our clients indicate they face either on a regular basis or from time to time. I'll tell you a quick story. We did a recent webinar with one of the big four firms who will remain nameless, and we gave a little challenge to the people on the webinar, which was just to work out an RIT calculation. And I don't know whether it was a simple RIT calculation. I don't know whether they were a bit younger and very, very competitive and wanted to get the answer first. But out of the people on the webinar from this top firm, 45% got it wrong. So, you know, human error is a thing, and we exist to create solutions to the problems and challenges that you are facing. So if you found yourself saying yes to any of the above of the poll questions and you don't already work with us, then it's highly likely that we've got something that can help improve your work practices. So I'm just going to touch on a few of those areas now. And we've got 4 slides on this, and then we're pretty much done. So you've all done very well. So again, looking at ways that we can help with those things that the polls have identified. So using the polling framework proactively, our platform can be used proactively throughout the year, and you can easily integrate into your provisional tax workflow. And because we have IRD data flowing into our system, our smart tools know exactly how much tax you need and at what dates to remain compliant. So it's super quick, safe, and accurate. So looking first of all at the idea of being proactive, common practice for New Zealand companies now is to pay tax funds into our public trust tax traders tax pooling account up until 10 o'clock at night. And at any given day, and we'll credit it as being paid on that date. By doing this, you can obtain a short-term refund of the amounts you've paid, even if you have tax to pay for that period, should this be helpful, and you don't need to file an estimate in order to do this. So this can be a really useful alternative to an overdraft or more expensive forms of debt if you have a short-term funding need that would allow you to subsequently reinstate the tax position before you file your tax return. It's good to know that if you have a number of entities within your group structure, our tools can assist by enabling you to see all of your tax-paying entities displayed via a single login with inland revenue data included, and a group account that combines the data from all the separate accounts into a single group entity. This allows you to easily reconcile payments made with expected liabilities, so there are no surprises. You can also save time by depositing all your funds for related or associated entities into the pool under one entity and allocating the funds to the entities later. Also, if you deposit and overpay your tax, we can provide you with premium interest on that overpayment. For our partner companies, at the moment, that's at least a 1% premium over inland revenues rate. Obviously, if you overpay IRD right now, you'd get a nice round figure of 0. So for many companies thinking about this, using the tax pooling framework, they're really thinking about using the tax pool as their tax account, making tax payments into the public trust tax traders pool when it suits them, simply using the IRD number as reference. And, with your inland revenue account connected, we're able to display your inland revenue minimum payments alongside your tax pool payments, so you can easily see at a glance whether you're covered or not. If you're short, the solution is literally a click of a button away. Our smart tools work out how much is due and when, and then present you with 4 customizable strategies for how you might pay this. We're the only provider in this space offering this combination of automation, accuracy, and functionality. And this speaks directly to those 4 poll questions we posed: being proactive, reducing the need for manual calculations or spreadsheets, doing away with deciphering IR statements or relying on separate data sources, and eliminating human error. If you prefer not to set money aside to cover your tax, or if you prefer to just pay your income tax as it falls due, then we can offer a number of prearranged funding solutions for you. So we arrange for the tax to be paid into the tax pool on your behalf, and you secure a period of time in which to pay for that tax. And again, we saw the huge increase in that in 2020, but also continuing through to 2021 and onwards. So interest can be paid up front with principal and arrears, or payments can be made principal and interest, either as instalments or as a single lump sum. But again, with the rising interest rate environment, we understand there's added pressure on cash flow and an increased desire to not make a mistake. And that is why we offer something called Fee Guard, which is complimentary on all interest upfront funding arrangements. It's only offered by tax traders, and this ensures that you only pay for what you use. If you pay interest up front and don't need all of it when the maturity date arrives, we'll give you back the interest paid on the portion you don't need. And for full details of this, you can just head over to our website. So we've got through a lot this morning. I think you've done very well. Thank you so much for being part of this. I'm hopeful that you've understood a little bit more of some of the intricacies, the options that you have for paying your tax. I hope that's increased. In particular, thinking about rising interest rates, the extension that's now available with the recent legislative change. I hope it's been helpful to think about the way that we've seen other companies respond to COVID and, fingers crossed, the post-COVID environment that we all hope we're in, and some ways to improve your own practices. In closing, it's worth saying that at Tax Traders, a strong commitment to social justice sits at the heart of everything that we do. We desire to see people flourish and grow, our clients, our team, our communities, And this deeply affects the way that we invest in relationships and innovation. This is why we were so proud to be awarded B Corp certification in March, which is an independent accreditation showing that we meet the highest standards of social and environmental impact. We were pleased as punch with that one. We absolutely love what we do here at Tax Traders. We love working with innovative New Zealand companies every day. So I know we've got Q&A time, but if there's anything that you want to talk through at any stage, or if any of the data we've just talked through has piqued your interest, drop us a note, send us an email, send me a note. I'd love to help. Thank you very much for joining me today. Thank you, Linda. Thank you, Katrina. And I think hopefully we're a little bit under time, so we can take a moment for any questions that have cropped up, or you can finish early. So I'll hand over to you, Katrina.
Great, thank you so much, Nicola. That was fantastic. Look, that's really, really great. So what we'd like to say, look, if you have a question, please pop it in the chat now, and I can pick that up and read that out, and then either Nicola or Eric can respond, and we'll go from there. But so just again, we've got a great number of participants attending today. So if you have a question that's burning there, it's probably a question that others will have as well. So please pop it into the chat, and we'll pick those up. I do have a few questions though, if I'm allowed to jump in while people are busy putting their questions in there.
Sure.
So I note, and you may have sort of covered this already a little bit, but just if you could sort of, I note that even though Inland Revenue has offered remission of use of money, interest and late payment penalties from March 2020 onwards,
Yes.
taxpayers have still chosen to work directly with you as a tax technology company. So even though that there was, a cost attached to that, so why is this? What's driving that?
Look, it's a really great question, and we didn't quite know how that would go, what the impact of that legislation would be. But again, what you saw in one of those, I think the very first chart that we showed, was a huge increase in companies deciding to effectively use the private sector to achieve a result they may have been able to achieve with Inland Revenue. We've got anecdotal evidence of this, so we haven't polled our client base on this, but what we know is important to them is certainty, particularly if you think back to that March April 2020 time. They knew that they could pay their tax at a time that suited them with certainty using our tools. There was some uncertainty over whether they would meet Inland Revenue's criteria, how long that would take, and that kind of thing. So I think certainty was probably the biggest factor. I think also we're nice to, we're easy to deal with. Our interface is really great. We do have a great Inland Revenue department in New Zealand. They're very innovative, but for many companies, they still prefer to deal with our interface and to deal with our tools to get the outcome they want. And of course, there actually was no criteria, or there is no criteria for using our tools to defer your income tax payments, whereas there were criteria under the government's remission scheme. So I think that they're probably a couple of the reasons, but again, that's mostly anecdotal feedback. And actually, I was with Inland Revenue last week, and I passed this on, and I showed them some of this data, and they were very interested by that. Thank you for the question.
Great. Thank you. Yeah, that's right. And the thing is too, is I think that's that whole partnership thing. People like to have someone that they can partner with and feel that support. So that's fantastic. We do have one question that's come in. So someone would like to know more regarding how tax pooling and how does that work? So
okay.
Yeah.
Well, tax pooling is an IRD approved system that was passed into legislation by the Labor government coming up to 20 years ago. And the goal there was to really reduce the burden of provisional tax payments by companies. And so the framework that was put in place basically allowed unders and overs of tax payments to be traded with better results on overpayments and fewer late payment penalties and use of money interest on underpayments. But for a really lovely, succinct explanation of that, just jump onto our website, taxtraders.co.nz, not only can you read about the basics there, but there's a number of video demonstrations and tutorials to talk you through how you interact with our tools. That's just the basic, I guess, framework of what we do, and we've really we've invested considerably into automation and technology, because at the time that we, I guess, set up Tax Traders, the benefits of tax pooling, which are significant, were really only available to really large corporates. But by automating the process and by making it really simple and really quick, we've enabled that to be available to more and more companies. So for us, the tax pooling framework, it is the framework that underpins our work. But what we're really interested in is making sure that more and more companies benefit from the benefits of that framework. But jump online and have a look. But thank you for the question.
That's great. And that does sort of roll into, we've got a couple of other questions, but roll into my next question, which is about tax technology and the importance of that and your approach to that as an organisation. So, you just touched on it, but could you expand that a little bit more?
Sure, yeah, absolutely. So actually Josh is my husband, we co-founded Tax Traders on our kitchen table in Onehunga many years ago. We saw a real gap in the market, and again, we felt like the benefits of the tax pooling framework were only at that stage available to big corporates. We felt like there was an issue of equity there, and that those benefits should be available to all taxpayers, to every New Zealand company. And so the only way you can really, I guess, expand an offering like that is if you make it very, very quick and very, very easy. And the only way to do that is to automate it. So our tools do a lot of the heavy lifting for you. They work through, ROT, and then what is the ideal way for your company to be paying that tax. And automation has been the way we've got there. I mean, I suppose, interestingly, my background is in law, just a little bit of tax, but law, I don't have a background in software. But what we were able to do is to hire software engineers. We have them in-house. We have them living and breathing our clients' needs. We have them living and breathing tax and accounting, and they are able to do a wonderful job of creating tools to make using the tax pooling framework really, really efficient for you, really, really quick and easy. And yeah, that's what we love doing.
Fantastic, thank you. Look, another question that's come in on the chat is, given the low interest environment, what sort of return do taxpayers who have money in the tax pool get on their money? Sorry,
I'm just I just lost you for a minute there.
Sorry, do you want me to repeat that?
Yes, please.
Yeah, given the low interest environment, what sort of return do taxpayers who have money in the tax pool get on their money?
Oh, yeah, no, I got that. That's a great question, because again, the low interest rate market, the low interest rate has really changed things at the moment. So we aim to provide at least 1% above what IRD are providing. So it's always competitive. Eric, did you want to jump in on that? You're all over interest rates.
Sure, yeah. We try and offer at least between 50 and 100 basis points above what Inland Revenue usually offers as their credit UOMI rate, but that can obviously be sometimes more depending on demand for a particular tax date, because we've got depositors that put in the pool at various dates in time, and the beauty of tax pooling is there's always unders and overs, and we've always got specific demand for specific dates. So sometimes it can be over the usual 100 basis points, but sometimes it might be a little less. But we as Nicola did mention, we do try and offer a premium over Inland Revenue's UOMI rate in any event.
Cool.
Great, thank you. Next question that's coming from James is, do your tools give any indication of the financial health of New Zealand businesses?
I guess the tools themselves are assisting companies to pay their tax in the optimal way. But what we can see from that data set of how companies are using those tools, so that's the over 12,000, is are they paying less tax or more tax? And particularly that section at the end, are they falling out of the tax pooling system? Because if they are falling out of the tax pooling system, that's a very good indicator that they are not profitable or that they've gone out of business. So that's probably where our data set can provide some helpful insight. And we do talk to MB from time to time. They're interested in looking at that data, again, because it's kind of real life to the minute data about how companies are actually paying their tax. So yeah, I think what you saw in the increase in on-time payments was clearly, which really reflected what we saw happening around us, which was, okay, companies have their confidence back. They're paying their tax, they're wanting to pay it on time. But then what we see in that who's falling out of the system is those smaller companies. So that's what our data's set's showing, and that probably accords with what we're experiencing around us.
Great, thank you. Right, next question is, does your tax trader system plug into other ERP systems, so seamless working?
So what we found is the most helpful data connection that we can plug into is really in revenue data. And so we were the first tax pool to do that. And so that means that you've got your tax positions held at IRD and your tax positions in a pool in one place. So we're always looking at expanding and we're always looking at integrating, but that's our primary data connection at the moment.
Okay, great, thank you. And one more here from Angus. For those who underpay tax, what is the saving on the use of money interest?
Eric, you jump in. You have the up-to-date numbers on the tip of your tongue.
Broadly, it falls in the range of around 30%. Is what you'd save over late paying inland revenue, although as rates are currently going up, it might be a little less, but that's broadly what we find taxpayers are saving generally when they go through tax pooling if they've failed to make a payment to inland revenue on time or late paid inland revenue.
Yeah, and again, it's not just the saving; it's also having that flexibility to, I guess, pay at a time that suits you, that suits your cash flow, and all those other benefits that we saw companies really make the most of in the lockdown periods. Which was, if you have deposited into a tax pool, then you can grab that money back. So there's a lot of benefit available.
Great, thank you. And another one here is, if some companies are falling out of the tax pooling system, can it mean that they're paying in time? It's another perspective.
Yeah, that's a great question. And we've looked quite carefully at our sample size, because what we see is that once, particularly one of those smaller companies, once they establish a habit of using a tax pool, they will continue in that habit. And there's a couple of reasons for that. Generally, their accountant has recommended that they do that, and then they form the habit of paying into a tax pool. So whether they're paying on time or not, we can see that, because if they're paying on time, they're paying on time into our tax pool. So I hope that makes sense. So
yeah.
So when we say that a taxpayer is falling out, we're very certain that actually what's happened is they're not profitable, or they've shut down, they've gone out of business, because paying on time still means that we would have visibility over that.
Yeah, that's good. Thank you. My other final question, if you've got some other last minute questions on the chat, just please pop them in while we've got a couple more minutes left. But this is slightly off topic, but I did note, and you mentioned it at the end of your presentation, that you recently got the certified B Corp. So can you tell us why you did that, and was it a difficult process to go through? Because that's I'm just intrigued.
Yeah, such a great question. And as a B Corp now, our eyes have been open to all the other wonderful companies around New Zealand that are B Corp. So if that's you on the line, hey, nice to be part of your family. So we wanted to find an independent, international way to kind of signify what kind of business we are. So we investigated the B Corp certification process. It was quite a difficult process. Not difficult, it was a long process, not because we had to change our behaviour, But because we had to document everything and write all the processes down that we had already been using for the last couple of years. So when Josh and I founded Tax Traders on our kitchen table in Onehunga, not only did we want to make sure that the benefits of the tax pooling framework were available to more taxpayers and to every New Zealand company, we also had a real desire to show that business could be a force for good, business could be done differently, business could have purpose and mission at its heart and put its people first. And so that's always been a real driver for us in our business. And having the B Corp certification was a really great way to signify what kind of business we are, but also to encourage us to continue to do better and better and better, and to be part of a community that's really focused on doing business in a better way. So an inclusive, equitable and regenerative economy is what we're about. So I encourage you, if you're that way inclined, it's a fantastic process to go through, and you're joining a really wonderful family of New Zealand companies.
That's fantastic. Thank you. That's great. I think you'll have people after this going to Tax Traders website, but also to find out more about B Corp as well. So I think you'll have achieved both ends today.
Oh, so, that's very kind. Thank you. Good.
Yeah. Look, I think we've probably we've got no more questions that have come through, so we'll wrap it up there. But just wanted to say a big thank you to both Nicola and Erica for a fantastic webinar. Thank you to everyone for your participation, for your attendance today. If you are ready to leave us now, then you can do so. That concludes today's webinar. And to exit, you've just got to click on the X at the bottom of the panel. And as you exit, you'll be directed to a feedback form, which takes about 30 seconds to complete. So we encourage you to do that. Feedback is really beneficial for CPA Australia, as well as for our panel. And we certainly review your feedback, and so we'd really appreciate if you can take the time to do this. Just letting you also know that everyone will receive a copy of today's webinar recording, and this will be sent to you via email within 24 hours. So again, you'll be able to review this as well. So thank you all. Thank you again, Nicola and Eric, and Tax Traders. Lovely.
Thank you so much for having us. Thank you.
Okay. Bye.
Bye-bye.